Okay, tonight we're going to finish chapter 17 handout. It shouldn't take too long, I don't think. Chapter 16, 17 multiple choice, we'll do those. And that's it for the class. Hopefully we get out early tonight. We'll see. But after class, I'll email the 16, 17 exam. It's due on the 5th of May, which I think is a week from Friday. And that's the last exam of the class. Yay. All right, so let's go to so we went through the opinion for the ACCT433, the non-issuer opinion. And now we're going to go through the publicly traded company, the PCAOB opinion. And you'll notice that the terminology is a little bit different. This is actually the old terminology that we used to have at the ACCT, but they still have it for the PCAOB. When the PCAOB took over, they basically took all the AICPA's stuff and said, can we use it? And the AICPA said, sure. So basically everything was just transferred over to the PCAOB. Now the PCAOB from that point on, though, makes their own standards. Well, they still have an audit report that's very similar to the old audit report that the AICPA used to have. The AICPA, their old audit report looks very similar to the one that we are going to look at today. But anyway, the PCAOB, though, they have their own set of rules, and it'll say right in the report that you have to follow their set of rules. Now, there is one thing that is right at the title of the report. They don't just say independent auditor's report. They throw in the word registered. The CPA firm must be registered with the PCAOB to do an audit of a publicly traded company. So you have to be a registered CPA firm with the PCAOB, and you put that right in the report that you're registered with the PCAOB. And while the PCAOB cannot take a CPA license, they can revoke your registration or limit what the types of audits you can do. So while the PCAOB might sound like they don't have much power because they can't pull the license, if you're a large CPA firm and they unregister you, it's pretty much a death knell for them. So anyway, the one thing that they did do that is different than the past is they put the introduction basically, and then the audit opinion right up front. They used to put it at the end of the audit report, but everyone would just run to the end of the audit report and see what the opinion was. So they put it right up front. So the first one is we have audited, and they go to the financial statements, the 4 financial statements. And then they go right into the opinion. And the wording is pretty similar. Present fairly, material respects, financial position, which again is the same thing as, anyone remember? The financial position is the same thing as the
balance sheet.
Good. Oops, that's not how you spell balance sheet, though. Yeah, so financial position is balance sheet. Why I don't call it balance sheet, I don't know. I think I have seen audit reports where they actually call it the balance sheet at the end here, but usually they call it financial position. Results of its operations, which usually is indicating of the income statement. And its cash flows, which are just the cash flows. Statement of cash flows. In conformity with the applicable financial reporting. Now, for publicly traded companies, this is either going to be US GAAP or international GAAP, which is IFRS. International Financial Reporting Standards. So these are the two kind of choices you have in the US, basically. And the US does allow for international standards to be used instead of US GAAP. And you have some companies that are international, and so it makes sense for them to report in international standards if they're heavily diversified in, international markets. Okay, basis for an opinion. They cut this down quite short. They shorten up some of the company's management. You remember up here, the AICPA goes into a long list of company management responsibilities, kind of go into a long list of auditor responsibilities. A little more background. It's pretty short here. They come right out and say, financial statements are the responsibility of the company's management. Our responsibility as the auditors is to express an opinion. Let's make that green up. So the financial statements are the responsibility of management. Our responsibility is to express an opinion on the financial statements based on our audit. Again, that's identical to what we have in the sorry, I had to sneeze. That's identical to what we have in the AICPA standards. And again, they get into that they are registered, the PCAOB. And notice, instead of saying we conduct our audits in the standards of the US, whatever, that we had in the first one, they say we are under the standards of the PCAOB, not the AICPA. And in fact, if you look through here, the AICPA is not mentioned because the standards are PCAOB. I take that back. They're not the auditing standards. The auditing standards are of the AICPA are not mentioned. US GAAP, that is AICPA standards. It's I forget the name of it now. Anyway, that is the US standards are AICPA. Okay. Now, similar to our key audit matters, they have critical audit matters. Now, these are a little bit more defined. And generally, they come in two flavors. Relate to accounts and disclosures that are material to the financial statements, and that they are involve are especially in challenging subject or complex judgments. So the critical audit matters do not take away from the opinion of the financial statements. They are simply things that they feel that people ought to know. And so here are kind of a list of some of the critical audit matters. Material accounting estimates, they're generally big stuff. It's generally big stuff. If there's a large amount of judgment involved, and some of these things are really big. I'll tell you one that was kind of big fairly recently. Sometimes you have stuff like this come out for media companies, streaming services. A few years ago there was a handful of them, and now there's I don't even there's hundreds, probably maybe even thousands of them, of these streaming services. And so, they put a significant investment in this. And now they're, a couple years into it, and it's obvious that these are not going to pan out the way a lot of them thought they were. So you have these really significant estimates of how much revenue they're going to get from these streaming services and that sort of thing. And quite honestly, just a lot of them have never materialized. And part of the reason was there was these few companies that were making quite a bit 5 years ago or whatever on these services. And now that you have so many of them, that if they were charging $20 a month or whatever it was, well, you multiply that by 100, no one's going to pay $20,000 for 1,000 different services. And so, the idea was the market was not as big as all these services were. So you have kind of significant write-downs to some of these came about. But those are judgments, and those judgments, again, can be huge. These companies bet billions on those. Okay. And you can kind of read through some of these, but they're generally for things that are iffy. They have a lot of judgment to them, that it is not well known. One of the things that people, I think, a lot of times don't understand is that auditors don't have crystal balls. We don't know how long things are going to last. We don't know how long assets are going to last for necessarily, and especially a lot of the really big assets. What are they? Sometimes you have an assembly plant or something like that that is very expensive and it can produce tons of money, but if you cannot have a car to produce in it, it's worthless. So a lot of times you have these really large things, and the judgment is very difficult. When the this is ancient history, like 2008, 2007, 2008, when the housing market was collapsing. I know you can't, I was born then. Anyway, when those markets collapsed, people were saying, well, why didn't the auditors know this? Why didn't the auditors say something about it? Well, they didn't have a crystal ball. And all these houses that were on the market for $800,000 and they had a $700,000 mortgage, they were fine. They were $100,000 in the plus. The next year when that house was worth $500,000 and the loan was $700,000, that was a problem. But again, auditors didn't have a crystal ball. We don't know any more than anyone else. And that's part of the good thing about these critical audit matters, is that you can actually explain to people, look, some of this stuff is beyond normal historical information. Okay. So once you find a critical audit matters, what do? Identify it, get the principal considerations, reference what the standards are that are around it, what the disclosures are, and how it was addressed by the audit people. So identify the problem, describe it, and then also look at what the standards say about it, and then also to describe how the audit, during this audit, how did they deal with it? So these are all things that are required by it. Okay, the CPA firm signature is on the audit report. We have served as a company auditor since, and they have to tell the year in which they started it. City and state or country, and the date. So this is, if you look at the two reports, this is a very cut down report. The actual verbiage here is actually fairly short. I mean, this is, you know, when I went through, it was 3 paragraphs. Now it's 4. But, you know, some of this is just stuff tacked on to what was in the other ones. So, you know, this is it's actually a very short program, but that is very similar to what we used to have for, you know, now the new one for the ACCPA is pages long of description, but the PCAOB one, and I think probably because the idea is that maybe people who are dealing in issuers, you know, big company, they're well aware of what an audit is and that sort of thing, maybe more so than, say, a small firm that is not publicly traded. Maybe they don't know as well what is required in the audit, and investors in those firms too, those smaller companies that are not publicly traded. But anyway, it's a very cut down form. The critical audit matters. There are sometimes pages of these. A lot of times for large companies, they'll have pages of these, and they'll have all kinds of stuff, you know, uncertainties in the semiconductor market and all these other things that will come into play in companies that that are really kind of unknown, and they're huge dollars. They can be in the billions of dollars. So it's kind of putting it out there that, look, you know, be aware of these. Okay, so let's do some questions. Standard report of a non-public company has all the following elements except. I'll handle this one because we did this one last week, Brian. They do not make a statement on internal control. They say they look at internal control. Well, let's go take a look at it. They say they look at internal control. So they get an understanding of internal control, but no such opinion is given to it, and they don't report on it. All they do is say, hey, by the way, we looked at it. But they do not give an opinion on it. So non-public companies do not give an opinion on it. And there's actually a kind of an asterisk for the publicly traded. Okay, so this is the standard non-issuer. They talk about management responsibility, nature of an audit, sufficient audit evidence, opinion on the financial statements. Those are all there. They do not give an opinion on internal control. Standard public issuer. I think I talked about this. Which one don't they have in there? Actually, there are 2 in here. By definition, there's 2 of them that are not in there.
Would it be A?
No, they have managed responsibility. It's nowhere near what we do in the other one.
It's B.
Yeah, but no, it's easy to miss the company's management responsibility, but the first sentence there, and that's it. The financial statements are their responsibility. They don't go into detail or anything else about it. It's just a one-liner. Yeah, B, they don't reference the auditing standards. They may reference the accounting standards, but possibly not. If they're international standards, they won't reference the ACCPA at all. But if they're U.S. standards for accounting, the accounting standards will be referenced. This is kind of a wacky one, though, and that is this down here. And this is kind of a technical odd one. The standard report for financial accounting does not have an opinion on internal control. So there is no opinion in here on internal control. Now, here's where it gets kind of wacky. Companies are required to have an audit on internal control. And that audit on internal control, the company does an assessment, and the auditors audit the assessment that the company did. They don't actually audit the internal controls, they audit the company's assessment of their internal controls. I know it's kind of a technical issue, but that's the thing. So a company is required to have an audit of internal control. The audit of internal control requires a financial audit. So if you do an audit of internal control, you must also do an audit of the financial statements. And here's where it gets kind of legally. You can actually do a financial audit and not do the audit of internal control. If you do an audit of internal control, though, you have to do a financial audit. So, but you can actually do an audit of financial audit without doing the audit of internal control. You can't do it the other way around if it's that. And a company is required, if they have an audit of internal control, that they're required to have an audit of internal control. So then, you know, it would make sense. I don't know if it's ever happened where you actually had two different financial statement audits. I guess it could happen. But whoever does the audit of internal control has to do a financial audit. So long story short, it is possible to do a financial audit of a publicly traded company without doing the audit of internal control. It's not possible to do an audit of internal control without doing a financial audit of a publicly traded company. So as you can imagine, I would say 100% of the companies that do the financial audit also do the audit of internal control, because they're required. It's required to do the audit of internal control. But anyway, kind of a strange. I don't know why it comes out like that, but I guess the idea is that you could always get another opinion or something on the financial statements if you wanted to. But anyway, if you do an audit of the internal controls, you have to do the financial audit, and the reason is, in the audit of the financial audit, you might come across things that indicate that there's a problem with internal control. For example, if you find a material misstatement, that would indicate there's a problem with internal control that would apply to your audit of internal controls. Another weird thing about the audit of internal controls is that you're actually doing an assessment. The assessment is as of the year end. You don't care what the controls were in January, February, March, April. When you're doing the financial audit, that makes a difference. You know, if they had bad controls from January to March, well, bad things could have happened. So you actually look at the internal controls throughout the entire year if you're doing a financial audit. However, the audit of internal controls says, hey, as of 12/31, what were the controls like? Because the idea is going into the future, you know, what are the controls like? Are they okay? Can they rely on them and whatever? So it's kind of a wacky one that you run into for that. So technically, coming down here, you do not have to have an opinion on internal control or financial reporting, although I would think that about 100% do it. And so a lot of times, even though the test of controls are not required for a financial audit, publicly traded companies, they'll just automatically do test of controls because they are required for the opinion on internal controls. So anyway, all right. Any question on that? Okay, going concern. Do we ever talk about going concerns? I can't remember. I thought we did. Maybe that may have been a different class. Okay. Going concern is when the company is going bankrupt. Did we talk about this already? No? All right.
Yeah.
Oh, we did. Okay, good. Oh, you saved us from being bored for 5 minutes. Yeah, so but anyway, company going bankrupt now, in auditing, generally speaking, we, how well the company's doing or how bad they're doing, whatever, as long as the financial statements are not materially misstated, they are fairly presented, we're fine. However, the public was getting mad because they say they get a clean audit and then the company go bankrupt. And they were thinking that the auditors were evaluating whether the company was a good investment or not, which is not what we do. We only say the financial statements are fairly presented. You make a decision on whether it's a good investment or not. However, because there was this gap, so we started reporting on the what they call going concerns. Okay, so the going concern option has all of the opinion option has all of the following characteristics except, and this one is a little bit technical too. The thing that is not in there is this, and this is somewhat new. It's not within 1 year. It is at least 1 year. And it could be more. So this is the one that is not in. Okay. So it's when a company is likely to go bankrupt. It's not within 1 year, it's at least 1 year is the actual standards that they use. Now, these are the old standards, actually within 1 year, at least 1 year. It could go 2 years or 3 years or more. International standards are 2 years. Our standards could be 2 years or 3 years or 4 years or whatever, They use the phrase substantial doubt. And this is one that sometimes strikes people as odd, but they are required to put it in their footnote. So if you're a company, if the auditors indicate that you're going to get a going concern opinion, or even if they don't, you're required to put it in your footnotes. There's substantial doubt about a going concern. So they're required to disclose it in the footnotes. And if they don't, it's a violation. So, one of the things is, and this is a little bit different than it was before, it used to just show up in the audit report, the going concern. Now it's required that the company put the going concern in the footnotes saying, look, there's substantial doubt that we're going to last for 1 year, 2 years, or whatever the time frame that the audit is going through. So anyway, a company is required to put it in the footnotes. And it's considered a material misstatement if they don't. Now, also, the auditors do consider management's plan. So if management has a plan to get out of it, that's fine too. If they have a workable plan, we're going to do this, we're going to sell this, we're going to, whatever. They can, you as auditors, you may consider it if it seems plausible that it will work. Okay, so the one that doesn't belong there though is this one, and that is the 1 year, within 1 year time frame is now at least 1 year. It could go more, it could go 2 or 3 years. International standards are 2 years. Okay, emphasis of a matter issued for generally accepted accounting principles not consistently applied. This is one that is very common. And whenever you have a new accounting rule come out, whenever a new accounting rule comes out, a company will get these. And I think I told you, I've seen audit reports that have had 5 or 6 of these tacked on. Okay. And if this is a matter, which of the following characteristics? Management changes accounting estimate. Nope. If management adopts an unacceptable accounting rule, no, that's a misstatement. Must be used even if the financial impact is immaterial. If it's not material, we don't care. So what's this last one? Isn't that we don't care? It's like we have a bad attitude, but if it's not material, it's not material. Okay, so going through these, a change in estimate does not mean the accounting principle is changed, right? If you're doing straight line depreciation for this calculator and it's going to last for 5 years, you go, wait a minute, this calculator is only going to last for 3 years. You're not actually changing the principle. You're just changing the estimate. So when we change the estimate, we don't. The principle hasn't changed. It's still straight line depreciation. It's just we've changed the estimate on it. So we don't put it in the audit report for change in estimates. If they have an unacceptable accounting rule, that is a misstatement. And we have to figure out whether that is material or not. But an unacceptable accounting rule is not a change in accounting principle. That's not an accounting principle. And if the impact is immaterial, it doesn't really matter. So if it's a very small percentage of whatever they're doing. Now, the reason I say that these come about quite a bit, it could be changing from one inventory method to the other, LIFO to FIFO. That's a change from GAAP to GAAP. They're both accounting rules. They can both use them, but it's a change in accounting principle. So you put whatever the difference is. Okay, we changed from LIFO to FIFO. It made our inventory was increased by 27 million. Our income was decreased by 20 million, whatever. You'll disclose that in the audit report. It's an emphasis of a matter saying, look, there is a change in accounting principle. Now, whenever a new accounting principle comes out, and when I said I saw ones that had 5 or 6, there was this was maybe like 7 or 8 years ago. They had just a ton of them came out. They just happened to all arrive in the same year. But anyway, when a new accounting rule comes out, well, that's GAAP not consistently applied. Last year you used the old rule. This year you use the new rule that you're supposed to use. A new rule comes out and you're supposed to follow. Okay, well, you're doing it. You still get a paragraph in the audit report. It doesn't change the opinion. You get a clean opinion and have a whole bunch of these changes in principle. It has nothing to do with the opinion. You're just going from GAAP to GAAP, and so it doesn't change the opinion unless it was, like, say, it was an unacceptable rule or something like that. But it doesn't change the opinion. It's just telling people, look, last year they didn't have this rule, now they do. So here's the change from one year to the next, looking at this new rule they have. So it's very common for companies to have it, and they don't argue with you about those things because they have to do it. Okay. And this one's almost kind of common sense. The other matter paragraph issued for uncertainties. So it is possible there are uncertainties that you put into an other matter paragraph. So other matter paragraph issued for uncertainties. So it gets tacked on. It does not change the opinion. But the question is, what kind of uncertainties do you think they are focusing on when you put it actually in the audit report? If you want to tell people, about something other than the normal run-of-the-mill stuff, Which one of those did you probably put in the audit report?
Is it B?
Which one?
B?
Yeah, C.
Close, right?
Huh? Yeah. So,
I said close.
oh, what did you say? Oh, okay. Well, anyway, normal uncertainties, for business. I think we talked about this. Car manufacturers, people crash cars, they get sued for that. That's a normal uncertainty. Uncertainties that can be reasonably estimated, those should already be disclosed. So these should be disclosed if they can reasonably estimate them. If you go, okay, this lawsuit is probably going to be 10 million or whatever, they should have some kind of disclosure for those. So you really don't need to put those in. The unusual uncertainties, this is the one that we're going to tell people about. And things that are required by the auditing standards, we generally don't put in there either. We don't put, our steps or whatever that we have to do for auditing in there. But these unusual uncertainties, these are the ones that we want to tell people about. Like, oh, by the way, this is kind of wacky. Heads up. We're not sure on this. These require judgment. So these are kind of the uncertainties that we're going to look at. And again, we do not do anything for normal uncertainties of any particular business. And ones that can be estimated, they should already be disclosed. If they're not, it's you'd give a modified report on it. Okay. Other matter. By the way, I didn't break this out, and I should have. I didn't make the distinction that I should have been. I'll show you what I'm talking about in a second here. You might be wondering, because I didn't say anything about it, what's the difference between emphasis of a matter, right? What's the difference between this and an other matter, right? One's the emphasis of a matter, and one is the other matter. Emphasis of a matter is something that's already been disclosed. So, emphasis of a matter, and I should highlight this. These are things that have already been disclosed. So this going concern, they have to put it in the footnotes. It's already been disclosed. You're going to put in your audit report. You're going to say, oh, by the way, and look at the footnote, footnote whatever 52 or whatever footnote it is. So emphasis of a matter is already disclosed. Same thing down here. When accounting principle changes, well, companies are required to put their what accounting principles they're using for all the major accounts. They're required to put those in the footnotes. So these will be in the footnotes too. Okay. All right. So emphasis of a matter is these have already been disclosed. Both of these will already be in the footnotes, but you're bringing them up and putting them into the audit report. So people say, you take a look at this, they're going bankrupt, or take a look at this, they changed accounting principle. The new accounting principle is in the footnotes, but we're telling you in the audit report too. Other matters, these are things that are not disclosed. So these are things that have not been disclosed. And again, unusual uncertainties, they can't disclose, they don't know what they're going to be usually. So, they're not already disclosed. Okay, additional circumstances. Now, this is, a lot of this is for things like subsequent events and other things in here. Again, is for things that are very large and for things that are beyond the usual scope of the audit. So they may include all the following except. So which one of these things is probably not going to be in, or is would already be taken care of in the audit, I should say.
D.
It's possible. Now, companies are required to put related party transactions in the footnotes. The one that probably doesn't belong there is this inventory thing. This is more like a audit problem. You know, you got to work out somehow. And if it's material, you can give a disclaimer. If it's not material, it shouldn't be brought up. But this is usually something that's handled in the audit itself. But things that go in other matters, important subsequent events. Okay, so let's say they have a big merger with you know, a big competitor or something like that. A major catastrophe. You know, they had a big fire that knocked out, or a hurricane that knocked out one of their warehouses. Significant amount of related party transactions. This one is possible that it doesn't belong there because they should have that disclosed. But if it happened after the end of the year or something like that, I guess you could put it in there. But generally, these are things that are not disclosed, and usually a significant amount of related party transactions. The only thing that kind of makes this one maybe not as important is it says the amount. It does not necessarily mean it's a dollar amount. It could be the number of them. But anyway, the one that's the most obvious that we don't need to put in there is this one. We don't get to bring up the details of inventory stuff. You know, this is either you put it in the opinion, change the opinion, or you don't, kind of thing. Significant amount of related party transactions. This should actually be in the footnotes, though. So this one probably would be like, I would say, the second best. I don't think I know if I told you this or not, but on the CPA exam, it's the second best. So it's not a bad idea. I mean, if the second one, if B wasn't there, I would say this is it. It is possible that you wanted to flesh something out that even though it's disclosed, maybe. But generally speaking, you know, you don't put things like that are steps in the audit in there. The CPA exam, the actual rules on the CPA exam, and these can be irritating, are that you pick the best. You know, they'll say pick the best answer of these, and that's it. So it is possible to have two right answers, but again, there's that judgment thing, which is the best one. But yeah, the related party transactions, though, are generally, especially if they're material, they should be disclosed of in the footnotes. And I think I told you this too, maybe I didn't. If you do have related party transactions, you cannot say that those are arm's length transactions unless you have definite evidence that they are. You know, for instance, if someone bought, let's say that, I think I mentioned this before, where someone upper management bought land from the company. If it was just a land deal that they negotiated with a company and they bought, you cannot say that that was an arm's length transaction or that it was done at fair value. Now, if the company took the land and put it up for auction and someone bidding in the company, you know, they had active bidding against each other with outsiders and all that kind of stuff, and someone in the company won the bid, that's a little bit different. Now you have a market value. Or for instance, stock. If someone bought stock from the company and you could point at year end and say, look, our stock market price was $38 a share, and that's what we sold the stock to whoever. at, those are, but without that evidence, if it was just, I say, a land deal, you can't put that in if that was an arm's length transaction. And actually it is a material misstatement if you put that in. Okay. All right, group auditors. This one's gonna be ugly. What time is it? All right, group auditor and a component auditor. Okay, group auditor is the main auditor. And the component auditor is a subsidiary. This is when you have two different auditors. So you have a group auditor and you have a component auditor. Now, the component auditor is auditing a smaller subsidiary of the parent. So, let's say you're auditing IBM, and IBM has a subsidiary that's a smaller tech firm. Okay, so you have IBM, big company, and let's say that KPMG is auditing them. Big company, IBM, KPMG is auditing. They have the smaller company, the smaller startup, whatever, it's making, I don't know, phone apps or something. They buy this. Now they have a different auditor. Let's say they have Deloitte Touche. So you have big auditor, KPMG, and then the smaller company has a different auditor. Now, it is possible to reference the other auditor in the audit report of the main company. So the KPMG could say, we audited the financial statements, except for the small app company that was audited by Deloitte Touche. You can share the responsibility. This can only be done for US companies. International standards, you cannot reference the other auditor. You have to take responsibility for the entire company. If you take responsibility for the entire company, it'll include that subsidiary. So US standards, you can split up the responsibility. International standards, you can't do that. So US standards, if you don't split up the responsibility, you're responsible for the whole thing. And quite honestly, a lot of companies insist on that. So a lot of times, if you're auditing IBM says, look, we're not going to have a messed up audit report. You got to sign for the whole thing, whether you do all the audits or not. But it is possible, technically, that they can have, reference the other auditors. So that's what they're talking about here. Now, let's go through these. Which of the following is not true? Okay, first one is true. The group auditor may decide to share the responsibility. That one's true. If the responsibility is not shared, the group auditor must perform additional audit procedures. That's true too. So if you decide you are not going to share the responsibility, that means you have to get comfortable with those financial statements from the subsidiary. D is also true. They are not forced to rely on component auditors' work. It's possibly going to do yourself. This is the one that is not true, and we'll talk about it. Materiality level for the group level and component level are the same. No. IBM is probably going to have a lot higher materiality level than this app company that they own. Maybe the app company, maybe 300,000 might be material to them because they're small. IBM is huge. 300 million probably isn't material to them. So you don't use the same materiality that the little app company is not going to have the same materiality as IBM. And here's the thing too, it is possible that little app company maybe they get an adverse opinion that their financial statements are misstated. Well, remember, they're being judged on this $300,000 materiality. So it is possible that you get a bad, a terrible adverse opinion for the subsidiary, but for the large company, it doesn't really matter because a $300,000 misstatement on IBM wouldn't even, probably wouldn't even change one number on the thing. So, that you do not have the same materiality. So the group level will probably have a much higher materiality in some cases than the component level. Should we just push through this? Which is there? Yeah, we can probably get through this really quickly. I think we actually went through these before. Didn't we do these? I'm almost positive we did. Qualified opinion is when there's a material misstatement. It is not pervasive. And usually that means one or two accounts. Oops. And these are often called, I think I'm almost positive we covered this, except for opinions. So qualified opinion is when there is a material misstatement, but it's not pervasive, one or two accounts. And the financial statements as a whole are fairly presented. So financial statements overall are very presented. And this is often called an except for opinion, because you say everything is fine except for, and then you say the bad thing. So whenever you hear someone talking about an except for opinion, that's what they're talking about. It's a qualified opinion. I'll tell you how old I am. When I first, those were brand new. You used to only be able to get an adverse opinion or a clean opinion. And these were brand new when I was going through. But they are, whereas material misstatement, however, and by the way, you put in the dollar amounts. So the dollar amount of the misstatement is in the report. So if you're saying that the inventory is off by whatever, $6 million, you put that right in the report. Except for the inventory being off by $6 million. So everything's fine except for the inventory being off by 6. Okay, worst opinion. The misstatement is in the report again. Oops. Oh, I just messed it up. Hold on. I double messed it up. Okay. All right. So adverse opinion. This is when there's a material misstatement. But it is pervasive. It goes throughout the entire financial statements. These are saying that the financial statements are not GAAP. They are not fairly presented. cannot be relied upon. Oops. So this is the worst opinion, and this is saying that, that these are not GAAP. These are materially misstated. It's throughout the entire financial statements. The financial statements are not fairly presented. You can't rely on them. So qualified is when there's a material misstatement. These both have material misstatements. But they are both, but one says that it's not that bad, and this one says it's horrible. These two types of opinions are fairly rare. And you kind of see why right here. Because the dollar amounts are included in the financial statements. A company is not going to hide anything, be able to hide anything in the financial statements. So if their income of 300,000 is really a loss of 200,000, you're going to put that right in the audit report. And quite honestly, you tell that to them, the audit report is going to make it look really bad because it looks like they're trying to create a fraud. And you can imagine showing this to investors or showing this to a bank with an adverse opinion when it says right here, by the way, this net income of 300,000 is really a net loss of 200,000. So don't rely on these financial statements. That's not going to go over well, right? So these are very rare, and they should be. Hopefully, you tell someone, look, this is what we're going to do. And they'll go, okay, well, we'll change it because we want to get a clean opinion. And even if financial statements look bad, it's not going to look like we're trying to create a fraud, which is exactly what that would look like. So qualified and adverse opinions are fairly rare. And that's why. Now, does it happen? Yeah, you get people piling on the table. No, it's not. We made income of 300,000. Oh, you didn't. You lost 200,000. No, we didn't. You give an adverse opinion, you throw it at them, and you leave. So do they happen? Yeah, they're just fairly rare. For the most part, rational people won't. That's not what you're going to end up with. Okay. Disclaimer of an opinion. These are often called just disclaimers. Oops. And they are really no opinion. Oops. And in some ways, they can be. They can definitely be worse than a qualified opinion. We'll talk about that. And it's when there's not sufficient appropriate evidence. Auditors were unable to obtain sufficient appropriate evidence to support an opinion. Okay. So this is where you get auditors were unable to get sufficient appropriate evidence to support an opinion. So you don't have enough evidence. You can't make an opinion. And if you can't form an opinion, you give this disclaimer saying, look, no opinion. And by the way, are the financial statements misstated? We have no idea. And they generally don't show the dollar amounts. If they do show the dollar amounts, it'll be, that we can't verify all these different accounts. But the actual dollar amounts are not known. So the actual dollar amounts are unknown, if any exist. You know, you might say that we're unable to verify 500,000 or whatever, but you don't actually know what the misstatement is. Notice that's different than these two. You know, these two, you're telling them right up front whatever it is. It's 300,000. This was whatever. 6,400,000, whatever. You know, you'll put the dollar amounts right in here for these two. This one you can't really. I mean, you can say what you don't know, the dollar amounts you don't know, but that doesn't mean that they're misstated. So disclaimers, they actually don't have dollar amounts of misstatements because you don't know. If you knew what the misstatement was, you could give an opinion on it. Okay. Which of the following types of misstatements result in a qualified opinion? Anyone? Oops.
Letter B.
Yep. Yeah, it's material, but not pervasive, and usually that means one account, maybe two accounts, but it's not throughout the financial statements. You know, so for instance, if the inventory is off, you can say, well, look, okay, but the sales are okay, the expenses are okay, and blah blah blah. But it's not pervasive. Adverse opinion. I don't know if 8 was spaced wrong or 9. Adverse opinion is the worst one, and so this is C. And adverse opinion, both these opinions should be rare. There is a weird one that this one can come about by. Which of the following types of opinions, misstatements could result in a disclaimer of an opinion? D. Now, it is possible that let me come down here. Scope limitations. Scope limitations are, this is why evidence can be gathered by the auditors. I should say reasons. And it makes a difference as to what the reason is. So which type of scope limitation is considered the most serious? Circumstance imposed. Fire destroys all the accounting records. Circumstance imposed. Nature and timing. This one's fairly new, by the way. They added this like in the last year or so. Which, by the way, means that this one is probably more likely to be tested on the audit on the CPA exam. And client imposed. The client doesn't let you have the information you want. Okay, for example, the client refuses to let the auditors communicate with the client's lawyer. So which one of these is the most serious, do you think? We may have already talked about this.
Letter C.
Yep.
Client.
Yeah. If the client doesn't want you to look at something, you know, well, first of all, that's exactly what you want to do. If you want, I think I always use the example that if someone, you know, there's a murder and they want to come look at my house, and I say, yeah, look wherever you want, but don't look in this closet. Well, that's the first place you want to look, is in the closet. It's the same thing when a client says, I don't want you talking to my lawyer. Well, now you got to talk to the lawyer because there's some reason why that's happening. So circumstance imposed are usually a lesser worry than client imposed. Client imposed virtually always gets a disclaimer. It is possible that you don't give it a disclaimer, but generally speaking, for the most part, unless you have a good reason why, because it creates uncertainty that you don't know what the scale is at that point. Whereas, these other ones, they had a fire, they probably didn't want to have a fire, and do nature typing, for instance, auditors hired after year end, maybe the original auditors backed out after year end, or maybe the auditor died or something, who knows. But circumstance imposed are usually not as severe. So it is possible a limitation is deemed possibly material and pervasive should have which type of an opinion. This one would be a disclaimer. Because it's possibly that it's possible that it could be so bad that it's pervasive. They can go through all the financial statements. For instance, if there was a serious if you could not figure out what the sales were. Well, notice that the sales relate to cash, relate to accounts receivable on the books, relates to inventory, what inventory was sold and bought and all that kind of stuff. So it is possible that if you can't figure out, say, what the sales were, or get some kind of comfortable with what they were for the year, that you might say, okay, we can't give an opinion on this. Okay, a scope limitation that is possibly material, but not pervasive. Now, this is where you get into somewhat helping the client. It is possible that you give them a qualified because it's not pervasive, saying, okay, even if our worst fears were realized, it's not pervasive. And then you get them except for, and the except for would still name the dollar amount, but it would list it as something that could be verified. Now you might say, well, why would you rather have that than a disclaimer? Remember, a disclaimer means nothing. A disclaimer is here's nothing. It doesn't tell anybody anything. So it may help the client. I know I'm running late here. It may help the client to at least get a qualified opinion where they say, okay, we can't verify this inventory because it's held overseas and we can't get into the country, whatever it is. However, the client can still say, look, okay, except for that inventory, everything else is fine. The cash is fine, the accounts receivable are fine, property, plant, and equipment is fine, the revenues are fine, the expenses are fine. It gives them something that they can actually say, take to investors or take to the bank and say, look, even though it's not a perfect audit, at least, you can rely on these numbers on, even though you can't rely on whatever is specified in the qualified opinion. So it is possible that there's a scope limitation that it is, you get a qualified opinion. Okay, a scope limitation that is deemed to be not material and not pervasive should have which type of audit opinion? Not material, and it's not pervasive.
Would be A.
Yep, excellent. Yeah, if it's not material, maybe you can't find it, but it doesn't matter because maybe the entire account isn't material. Doesn't go throughout the financial statements. is get a clean one, even though you can't find the information maybe you were looking for. But if it's not, but you deem that it's not material, yeah. Okay. Let's go ahead and save that. I am going to send out the no, not that. The multiple choice review. Let's go ahead and take a break. I'll pull up the multiple choice review here. And we'll say be back at 7:21. You can start working on these, and I'll put the poll up for it. And this is the last thing we're doing. Yay. Hey, let me start the poll in case you want to work on it. Okay. I just sent this out, but hopefully you get it soon. Oh, look, hopefully you got it. Is there anyone that did not get the, excuse me, anyone that did not get the, multiple choice? still working on this? No, if you are, you can go ahead and put it in chat if you want. No one? Okay, I'm gonna close up the poll here then.
Sorry, I'm sorry. Can you give me 1 second?
Yeah, absolutely.
Okay, done. Sorry.
Oh, no, sorry. Okay, let me share it. Okay, let's take a look, see here. First one. Okay, this one is a little bit tricky. It says which one would require an adjustment to the financial statements before they could be issued? So these are subsequent events, and we're talking about ones that would require an adjustment. Now, we're looking for basically type 1 subsequent events, ones that were on the books at the balance sheet date. And so the one they're most likely going to have is that one, settlement of litigation. All right, you guys got it. So this, so they had it on the books, this litigation, but it was settled in excess of recorded liability. And the idea is that, okay, if you have that information, then you don't have to do an estimate. Okay. Second one. Corroborating management's information for litigation. That's done with a lawyer letter, I'm sorry. And again, your main for litigation, you're mostly dealing with the client, but the lawyer letter should corroborate what the client has told you. Which of the following is recorded last? Generally speaking, it's gonna be this one. The management representation letter, this will be done the last day of field work. Oops, wait a minute, I guess I need a beginning parentheses for that. So this is gonna be done on the last day of field work, and basically it's everything you had. And if you look at some of these, you know, like confirming accounts payable and stuff like that, these are all things you should have done before. And reading the minutes of the directors and things like that, these are things that will actually be in the management representation letter. So the management representation letter is basically all those things, you know, do we have all the minutes for the directors meetings? Did you give us all the information for the financial statement accounts and that sort of thing? So those will all be included in that management representation. Okay, let's see. Which spelling is not correct relating to representation letters? All of these are correct. Except for the last one. I'm on the wrong problem. Hold on. You guys get this one. I'm sorry. Yeah. Yeah. The officer is a substitute. They cannot serve as a substitute. You're basically reminding management that, you know, the stuff that they gave you all the information, all that kind of stuff. And a lot of times if you hand them something to sign, if there is a problem, then you ask them what it is and, you know, go from there. The auditor's best course of action with respect to other information not included in the supplemental information included in the annual report containing an auditor's report is to is actually this one. I don't think I talked about that. I'll give you that. You read and consider the manner of the presentation of it. So you go through that, the annual report, and see if it's consistent with what you have for the financial statements, what you had on there. So for instance, if they say that revenues was 380 million, you look through and see if that is actually what's on their financial statements. And you actually don't do any of this other stuff unless there is a problem. And you don't make excuses for it either. You don't put it at all in your audit report. The question is, well, what happens if it doesn't match up? You can withhold it. You can put it in your audit report. That, you know, the information contained in the annual report is not consistent. It'd be other matter. Okay. When the auditor does not confirm material accounts receivable, but is satisfied by the application of alternative procedures, she normally should be if they're satisfied with alternate procedures. Okay, so So for instance, let's say for whatever reason, you couldn't confirm the accounts receivable. Maybe the people that you were dealing with said, we're not going to answer this. Well, you can find other information. You can find a bill of lading, you can find, other shipping documents. You match those up with invoices, look for paid invoices and things like that to verify that there is an active relationship and so forth with whatever the customer is. So anyway, if you used alternate procedures and you're satisfied with them, that's fine. Now, generally, you are required to do the confirmations of accounts receivable, but again, it's possible you don't get, their customers are not cooperating or something like that, where you can't get them to confirm their accounts receivable. The question is, what do? Well, you clear that with other methods. So maybe you get a bill of lading or something like that. It shows that the item was shipped. Okay. And by the way, if you clear it, it's just an unmodified, unless there's something else wrong with it doesn't say there's anything else wrong here, but if there's nothing else wrong, you just give a clean opinion. Okay, when financial statements are affected by material departure from generally accepted accounting principles. A material departure, okay. That looks like an important word. The auditor should probably C. It can be with withdrawal from the engagement is kind of a severe one, but it is a possible. Usually there's a material though, it's either going to get it's going to accept for qualification or an adverse opinion. Those are what we do with the material misstatements. It is possible enough that it is possible that you could withdraw from the engagement. That's a very serious thing to do, though. You could actually get sued for that. I can't remember. Did we do the MedTrans report or case? I can't remember if we did that or not. But withdrawing is if you're engaged to give an opinion, and by the way, you're a professional. And you have the professional law kicks in, like a doctor. A doctor, if they had a patient come in, they think they're going to do a routine surgery, and they come in and it's all messed up. The doctor says, and it runs out of the place. That's a serious infraction. You can't leave a client in a worse position than when they came in. So, if they hired you to give an opinion, you basically have a fiduciary duty, even if they're a lousy client, to give an opinion. So you got to be very careful about withdrawing from me, because you can get sued. They say, hey, we brought you in to give an opinion and you didn't give us an opinion and we had to get somebody else to do it or something like that. You can definitely get sued for that. There are a few ways out of that, but anyway, if you are brought in to give an opinion, it's best to, if you can, give an opinion, even if it's a bad one. They brought you in to get an opinion, you give an opinion. Okay. A scope opinion is least likely. Now, scope means you can't figure out what's going wrong. Is least likely to give an adverse opinion. Adverse opinion is when you know there's a dollar amount wrong. And actually, it goes back to here. This. These are the scope limitations. We gave a disclaimer, we gave a qualified, and if it's not material, not pervasive, we gave a standard. So this is adverse opinion. Adverse opinion means you know that they're materially misstated and that it's pervasive. If it is pervasive and it's, If it is pervasive and possible material, it's a disclaimer. Not adverse because you actually don't know. And the one kind of wiggle room one there is the qualified. You can't give them a qualified if it's material, but possibly material, but not pervasive. And that way you kind of assume the worst. You assume the worst result, basically. Okay, number 9. The client has changed the salvage value of its fixed assets. The auditor believe that this revised salvage value is realistic. Okay, so the auditors agree with it. Maybe they even told them to do it. The appropriate report is this would be unmodified. Wait a minute. No, standard. This is salvage is an estimate. This is a revised estimate. And they can get a it didn't change the principle. You're not gonna put any additional language on it. You agree with the estimate, so it's not qualified. And it doesn't show there's any uncertainty there. That should be standard to unmodified. Again, revising estimates, it does not show up in the audit review. So if you change the salvage value, if you change the years of depreciation from 5 to 3 or whatever it is, change the salvage values, increase them by 20% or whatever, as long as they are reasonable or realistic, those are just changes in estimates. There's a lot here. And by the way, audit reports, the reporting is a pretty big chunk of the auditing part of the CPA. An audit client has refused. Yep, disclaimer. And again, when somebody refuses and there's no other way you can get around it, there's no other alternate procedures, they get a disclaimer. Now, there is something that if the item is going to be clearly not material, it is possible to give them a standard report, but without you gotta be careful not to add words into CPA exam questions. And these are all CPA exam questions, by the way. These are all questions around the CPA. Okay. Let me save that. Yeah, let me save this. Okay, well, so here's what's going to happen. Let me save this. Okay, you guys get extra credit points for this. Hey. Okay. All right, so I'm going to go ahead and send the last exam, the one we've been waiting for. I'm going to send that out. I got to look at it. There's some things I got to take off of it. I put a bunch of stuff on there that I think it's just too long. There's 3 pages of essay questions, so give me a chance to kind of cut it down a little bit. It'll take a little longer to get to you, but it'll be quicker to complete. But anyway, I should get that out within the next half hour or so, or maybe hour. But anyway, so I'll send that out, and that's the last one. Oh, next week's class. So this is week 15. Week 16 is the last week. I will be here at 6 o'clock next Thursday. If you have any questions or you want to meet or you know anything you want to go over, I'll be here. I'm not going to cover any new material. Everything we're done right now with the class. But if you have any questions, and even if it's on the last test or whatever you want to talk about, that's fine too. But I will be here if it's absolutely optional though. You're not, no new material is going to be covered next class, but I will be here next Thursday. Any questions? Okay, great for having you guys, and I apologize. This took longer than I thought, but the good news is this is the last one. You'll never have to go through this again. So anyway, I will send out the exams shortly, and that'll be the last exam for the class. Okay, hey, great having you guys, and I will hopefully, well, unless you're graduating, hopefully see you again.
Thank you so much, Professor.
See you guys.
Thank you, Professor. Good night.
Night.